What we have here is a chart of the S&P 500. What I'm going to do now is I'm going to put on the Matrix Cycles add-on. So if I just right click, go to our main features, share script studies, and there's the Matrix Cycles. Okay, and see here up top there's a box come up, and if I click the plus, then go down to the button that says templates, and I'll select the MC1 template. Right, now we have the MC1 template put on there. What you'll see is this red line is the start of the cycle of the MC1. This red line is the start of the next cycle. What I've done is we split it up with some other lines, putting it into 4 sections. As I said before, the number 4 is important, but I'm putting it into 4 sections so it makes it easy to understand where you are. So the cycle starts here with the red line. This is obviously a quarter way through, halfway through, 3/4 way through the cycle, and here's the end of the cycle and beginning of the next cycle. Now in this MC1, as you know, there are 11 points, and of course on the MC1 cycle we can have inversion points, but that's at the end of the cycle, so point 1 either side of it. So at the end of the cycle of point 11 you can have an inversion point, which we'll call 11 inversion, then point 1, and potentially a point 1 inversion before point 2. Now to solve this, what we need to do is look at patterns. So we're looking at highs and lows. So there's a low here, high here, and similar situations, highs and lows along here. And most of these will be a matrix MC1 point. So we'll start by start off with, let's say, number 1. So we'll put on number 1, and we should make that down here next to the red line starting point. Then we'll put the next one, so point 2. Move that over here, and then we'll put in point 3, which will be here. As you see, the market moves up, pulls down here again, so that would probably be point 4. Initially it's a bit of a guesswork. You're looking at where highs and lows are, and then we're going to do the same thing over here, look for similar patterns. Once we found where the patterns are in a similar position, so for example here's the red line, there's a low here, we're looking for a low similar place, and we're looking for a high which is halfway between the red and blue, which of course would be about here. Then we're looking for another low point before the blue line, and over here is a low point just before the blue line. Now in the MC1 cycle, these points have an average position, but they have a plus or minus 3 to 4 days. So this point 1 here could be on average here, and it's come a couple of days early, or it could come a couple of days late. So if we look back over here, there is a low right next to the red line, but one is due around about here in reality. So on this occasion it's come early. Here, a few days later, it looks like that will be the position. So let's mark that point in. Now if that's that point there, we're going to then be going up to a point 2, which is about the right area. So we look again between the red and blue over here, and it looks like it's that position there, so we'll place that in there. And same with 3, looks like it's slightly later. Its average would be around about here. That's come a couple of days early on that occasion. Over here is a couple of days later. Mark that in. Bring it a bit closer to it. If you consider between here and here, beginning and the end of a cycle is 118 days, there is 11 points, so on average that will be round about 3 individual matrix points within each of the quarter cycles. Now just something to mention in the meantime, the red line is the beginning of a cycle, and again the red line is the beginning of the next cycle. Commonly on things like indices, like the S&P, the FTSE, the Dow Jones, the Nikkei, Hang Seng, so forth, point 1 will tend to be around the red line. So once you put the template on, have a look around the red line, look for a repeating situation, and that will commonly be the place of point 1. Other commodities and foreign exchange will be in slightly different places. Commonly things like gold and silver, point 1 will be around this white line. Right, I'm going to put the next few points in, so I'm going to put points 5, 6, 7, 8 to 9 in here. Okay, now I'll put a few more points in. I'll put the last point here, 11. Okay. Right, now from this red line to this red line we've got a complete sequence. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 and 11. Now theoretically from point 11 we should be going up to point 1. So we should be going from here all the way up towards like the red line. As you can see, the market goes up, stops way before the red line, and then drops down. And there's that point 1, same here. So that is an inversion point, and that's 0.11 inversion, and we represent that with using brackets. So I put brackets 11. So that's the 11 inversion point. Now from this side, once we've come down from the inversion to 0.1, we're then moving up to 0.2, which is in exactly the same place as it was over here, down to 0.3, 0.3, up to 0.4. So it inverted on the 11.11, but it hasn't inverted after 0.1, so it's just a single inversion. One of the other things you'll find when you first look at this, 0.1, either side of 0.1 is commonly big moves tend to occur. So quite simply seeing this low here, that was the easy way of determining where 0.1 is. And when you're solving this, you've got to remember the average position. So realistically, from this red line to this red line, that is one cycle. You need to do around about 8 cycles in all to find out exactly where the average point is. So this 0.4 here, you can see over here, it's closer to the blue line than compared to here. In which case, that 0.4, the chances are this is the average position. So that's a couple of days late, while this one is either on time or slightly early. This 0.5 is much closer to this white line, so 5 and 6 are very close. But over here, 5 is quite a way away. So again, if you look at the distance where it is, its average will probably be about here. So that is 4 days early. While here, it's probably a couple of days later than normal. Up to 0.6, which is just before the white line, as you can see. And then 0.7 here is just after the white line, while here it's a day before, in which case, on average, it's probably about a day after the white line. Now, this may look initially daunting to pick up highs and lows, but it's obvious. You can see the market is going up for umpteen days, turns and comes back down again, turns all the way back up, and as you can see, it pulls down, it goes lower than all these days before, and then it's a nice swing back up again. But some of these moves are big, and some of them are quite dinky, and there's a reason for this. This is just the MC1 cycle. Now, you need to look at the cycles with other cycles on top, because when a bigger cycle is moving, for example, up, you'll find each of these highs on the MC1 go higher than a previous MC1. So it's 8, down to 9, up to a 10, the 10 is higher than the 8. Down to the 11, that's not as low as a 9, and then up to the 11 inversion, that's higher than the 10. So what you're seeing here is the lows are higher and the highs are higher. Then, market turns back down and goes lower. And what this tells us is around here is a bigger cycle point. So from back here, you'll find we've moved up, that's gone higher, that's 3 is higher than the 1, the 4 is higher than the 2, the 5 is higher than the 3, but the 6 here is not as high as the 4, and then the 7 goes lower than the 5, which means there must be another point here on the bigger cycle, because that's caused it to turn down. The next point on the bigger cycle must be here, and is moving up because that 8 is now gone higher than the 6. So quite simply, if a bigger cycle is up, so MC2 would be the cycle above this. So if the MC2 cycle is up, then each one of these MC1 points will go higher than a previous MC1 point. And each of these lows will obviously be higher than a previous low. There is an exception to this particular rule, and this is mainly around the inversion points. So sometimes you will get the point will come in here on the MC2, but this point goes higher. Now this is an extra point, it's an inversion point, but we call it an extra point, and it has no reference as such to do with anything other than the fact it can just cause an anomaly in the market and make it change a direction. And it's just a temporary change. But as soon as the market goes down lower than an actual real MC1 point, then we know the bigger cycle is in. And another thing you'll find, which I'll explain on the MC2 later, is commonly when an MC2 point on a bigger cycle is due in this area, it will tend to come with an inversion point. Now, there are some little rules you can use along the way. Looking back here at point 1, as you see, the market has been going up till point 4, then it has changed direction. Now, as I said to you, this will obviously be a bigger cycle point. Now, just out of sheer interest, when a bigger cycle point comes in, obviously as it goes down, each of the matrix MC1 points will go lower. But the initial push, the first point, does not have to go lower. As you can see here, it's come down, it hasn't gone lower. If it had gone low, we know immediately that that was an MC2 point. Obviously as it came up here, it's not gone as high, so that's confirmed to us the bigger cycle is here. and then as it's gone down it has to then take this low out. So the only times it doesn't have to is if you have got an inversion point. So just a little rule of thumb, when a bigger cycle is up, each of these MC1 points will go higher. When the bigger cycle is down, each of the MC1 low points will go lower. The first initial move, it does not have to go lower on the first one. So bigger points here, as it's going down, 0.5 did not go lower than 3. Then we come up to 0.6. The next point down has to go lower than the previous one. So the only time that this can change is obviously in the inversion zone, so with an extra point coming in. The other thing you'll find is the average position. Now, because the bigger cycle is up, high points would tend to be on time or later than a normal average, while low points will tend to be on time or early. It doesn't mean it's going to happen all the time. So for example here, the market was up, with 0.2's arrived here, down to 3, up to 4, that's in its average zone. But as the market has turned back down, 0.5 has come later than its normal. If you look over here, 0.5 is quite early, it's quite close to the blue line, while here it's quite a way away. So its average position over here would have been around about where the mouse is now. But it's come early because the bigger picture was up, so the point is either on time or early. And as we come up to 0.6, that's pretty much on time to slightly late. Then it pulls down to 0.7. Now 7 is normally here just after white line, as you can see back here. And it's got pulled early because again the bigger picture is up. So obviously if you see the markets going up and you're looking to find out where the points are, all high points on the way up just look to be slightly later than expected, and again the low points will be slightly earlier, and on the way down the low points will tend to come later and high points will tend to be pulled earlier. Now if you find this a bit confusing or a bit difficult to do, doesn't really matter, because with the matrix add-on here for ShareScope, if you click here, we'll remove the template, so remove the MC1. And if you click cycle and say OK, as you can see it puts the cycle points on for you automatically. Now this is what we call a solution, and with the matrix cycles add-on for ShareScope we have a whole host of solutions already built in, and obviously this is the S&P 500. And this is already pre-programmed into the software, and it will go forwards in time for another 20 years. So with this add-on you get 20 years worth of already predefined points. As you can see here, this is where 0.2 was due, and it's come pretty much on time. 0.3 is due normally here, it's come slightly early because the bigger picture was up. 0.4 on time, 0.5 it's come early because again the bigger picture is still up. Look at the same back here. The high points either on time or late, and the low points will tend to be early. And one of the things you may be saying is, this inversion point, can we tell when that inversion point is going to occur? Well, we do have a hint. If the point 11 comes early, and there's quite early there, the chances are what it's doing is allowing space between itself and point 1 so that it can actually invert. So it's a bit of a hint. When point 11 comes early, market then goes higher than point 10, the chances are we're going to have an inversion point. If point 11 was on time, then the chances are there's going to be no inversion at all. And the same refers to point 1. If point 1 comes early, there will tend to be an inversion point. But here, as you see, it's slightly late, it's not going to invert. So 11 came early, it inverted. Point 1 came late, it's not going to invert. That basically concludes the MC1. Let's go on to the MC2 now.